Welcome to today's fireside chat, today's property pulse. We had our RBA meeting and they've released a statement in conjunction with that outcome. Simon, I'm going to hand over to you. What did they say and what do you think is important around what they've said?
Yeah, so the Reserve Bank left interest rates on hold this week in their meeting on Monday and Tuesday. And that's got a lot of people in the media speculating on whether that means that rates are on hold from now forwards for many months, whether they might actually come down, whether they're still likely to go up at the next meeting, which will be in August. And so we thought we'd dig into what the Reserve Bank's actually said as part of its decision and look for clues to tell us why they've made the decision that they have to keep rates on hold, but more importantly for us as investors, what might be coming next and what's going to influence the rates decisions moving forwards. Because obviously, as property investors, what we pay on our money, our interest costs are one of our single biggest expenses. So we're obviously keenly interested in what's likely to happen with interest rates. And that can have an effect on the sentiment in the market and people's willingness to transact as well, can't it, Brendan?
Absolutely. So, is the cycle of rate rise over, Simon?
Well, let's take a look at what the Reserve Bank actually said, shall we? So I'm just going to put up a copy of the Reserve Bank's statement. So I've highlighted a few things here that I think are worth calling out when we look at why they've made the decision, but more importantly, what might be coming down the track. They left the cash rate. So the Reserve Bank sets what's called the cash rate. It has an influence on what we actually end up spending on interest because it gets reflected ultimately in what the banks start to charge in interest rates as well. They left that unchanged at 4.35%. Now, we've had 3 rate increases already this year. So we've had 3/4 of a percentage point increases to get to this point. At this stage, they've chosen not to put rates up again, but not to put them down either. The Reserve Bank has 2 key mandates that they are responsible for. One is to try and constrain inflation so that the prices of goods and services are not getting away and heating up too much. And they have a target 2 to 3% band that they want to see inflation sit within. But their other mandate is also to maintain a level of so-called full employment, which is trying to make it not too hard for people to find work if they want to. But in terms of the inflation side of the equation, there's comments in here, and you can see I've highlighted one of them right here, that the latest data shows headline and underlying inflation is still too high. Now, headline inflation is what we see in the headlines in the media, but it doesn't take into account the fact that there's a lot of very volatile items in that measure. So things like petrol prices have obviously been jumping around quite a lot recently. Other costs, things like travel costs and so on, can be quite volatile. So what the Reserve Bank prefers to do is split all of those out and have a look at what they call the underlying or trimmed mean inflation rate, which ignores those more volatile items and tries to understand what's really going on beneath the surface. But they're seeing both of those measures as still being too high. In fact, both of those measures are still quite a way above their 2 to 3% target band. So they comment on that. They do talk about some of the changes that have been happening in the Middle East and to oil prices. So oil prices had peaked and come back a little bit. And obviously over the weekend, we've had the announcements that some kind of framework for a deal has been reached and signed off that is ideally going to result in the reopening of the Strait of Hormuz and hopefully allow shipping, particular transport of oil and so on, to flow more freely. But it is going to take some months, I think it'd be fair to say, Brendan, before that really starts to get back to anywhere near where it used to be.
The agreement was for a 60-day ceasefire so that they could come to an agreement on a longer term ceasefire. So it's an agreement to say that we want to agree on something, but we actually don't have an agreement that we're going to go forward with just yet, other than an agreement to work on an agreement. And you've got 60 days to do it. So it's temporary. And it's the 39th time that it's been reported that an agreement's been reached. And it's so there's an element of skepticism around the longevity of this. But at least had Trump had a happy 80th birthday.
Indeed, and it is perhaps a more positive sign than some of the iterations we've seen previously. But you're absolutely right. It's not a slam dunk. It's not a
No,
done deal set in concrete.
it's not it's over. Yay,
No.
dancing in
So
the street.
there's still a risk that we see things start to open up. You start to see shipping going through the Strait of Hormuz, but then something else happens in the next 60 days that all shuts down again. So we'll have to wait and see. There's still
And the
a
lag
high degree of
effect.
uncertainty.
Yeah, and the lag effect from the original interruption to the flow of fuels and fertilizers is still going to be influencing prices for some time. So there's we're not over this by any stretch.
No, correct. And even the past impacts of higher fuel prices, higher commodity prices for anything that's based around oil and petroleum products, fertilizer, as you said, Brendan, all of that is still flowing through.
Yeah,
And it's not like you can just flick a switch and it's all suddenly gone away and all good and prices are
yeah.
stabilized. It's going to take months before that happens, assuming everything goes relatively smoothly with this memorandum of understanding turning into an actual agreement. So we can't suddenly turn on a dime and go, well, all those inflationary pressures is just gone. They're still working their way through. And I think the Reserve Bank recognizes
Yeah.
that here. There's a few other things in the statement, though. Outside of the conflict in the Middle East, outside of what's happening with oil prices, they do mention that consumer spending has been slowing, which I think reflects a few things. Partly, maybe the impact of previous interest rate rises. There's been a general issue with poor sentiment. I think sentiment's back down to where it was during COVID times.
Yeah.
At the moment. So when people aren't feeling confident, when they're feeling anxious, they don't tend to go out and spend a lot. So all that's putting the brakes on consumer spending anyway, aside from higher prices at the bowser for your petrol. But that's potentially a positive in terms of inflation because it takes some of the demand pressure out. They do notice that also, as we're all keenly aware, momentum has shifted in the housing market, and that we're starting to see prices falling in some capital cities. Now, we're of course talking in the aggregate here. The median of a capital city doesn't necessarily mean that all prices for properties in every suburb in that capital city are coming down, but we are definitely seeing that starting to come through in the data, aren't we, Brendan?
Absolutely. So Melbourne and Sydney are in decline at the moment. Sydney worse than Melbourne actually at the moment. How long that lasts, we have yet to foresee. But the smaller states, the smaller capitals being Brisbane, Adelaide, and Perth, they're still in growth, although the rate of growth has waned significantly. So while they're still positive in those states, in those cities as an aggregate, the burn of growth has dropped back significantly. So we're back into single digits opposed to double digits in a number of those states. And the smaller ones are, again, they're mixed. So we're in a fairly mixed growth phase right now within the Australian capital. So it's really entertaining times. And as Simon said, you need to focus on the once it's all over the place as an aggregate, as a macro. That's when you want to really focus on what's happening in my area relative to what's going with my projects, and be clear on that, because that will determine and support the determinism of a great investing decision. So yeah, that would be the encouragement.
Now, it's interesting that there's not a lot of mention of the recent federal budget in the Reserve Bank statement here, or how that might be
Yeah, it
influencing
hasn't
the
flowed
property
through in
market
data
either.
yet. Yeah,
Correct.
I mean, the data around the recent budget, and you and I both know intimately, Simon, and I think everyone here watching would be fully aware of it. The impact on that in housing, but on also wealth creation models and structures is significant. And that ghost, that scare tactic, or that fear of change is really playing out in how people then choose. And it's not legislated yet. So there's a whole suck it and see moment happening right now without people actually able to make decisions. But that said, banks have already made decisions around their borrowing capacities. They've diminished investors' access to the same amount of borrowing that they once had. So it's a state of entertainment. Well, entertainment's a wrong word. It's a state of flux that the market's in right now. And yes, I'd like to suggest that's playing out. For the RBA, though, while that sentiment and the activity on the ground is playing out, the data lags in the
Mm.
collection. And it's going to take a good quarter of impact from this before the RBA can say, oh, there's a budgetary impact as well.
Correct. So the comment that momentum in the housing market has shifted is not really a reflection of any of the budget stuff, because that's all still too fresh. It's really trends that were already entrenched in some parts of the country. Now, the budget's likely to put the brakes on a little bit harder in some areas as well. And that'll continue to flow through here. And we'll probably see that like in August's commentary. But right now, what we were already seeing was a bit of a changing of gears because of those successive interest rate increases, I think, that we'd seen, and general impact on consumer sentiment. What else is driving into the decision? So we had also the unemployment data come out last month that showed that the unemployment rate in April was higher than the Reserve Bank expected, higher than a lot of analysts expected. The counter to that, of course, and the reason the Reserve Bank's not putting that much weight on that right now is that it's only 1 month's measure, and 1 month does not make a trend. But the fact that it's a bit higher, if that continues to be the case, that could start to become a more prevalent part of the decision making here. But they do observe that it was higher than expected. Obviously, a lot of uncertainties around the outlook for the economy, for inflation. They mentioned the resolution of the conflict in the Middle East again, here being at a very early stage. Still plausible scenarios where inflation is higher and activity lower than envisaged in their forecasts. So there's a lot of, we can see the historical trends at the moment, but we're not really all that confident on where things are going to go from here. So we could have a prolonged period of uncertainty that could cause growth to be lower. Taking all of that into account, they made their decision to leave rates on hold. If you look at some of the key messages in the decision commentary itself, again, they highlight the impact of higher fuel prices on inflation. So it's not just an issue that you have higher petrol prices, which are actually stripped out of their underlying inflation measure anyway. It's how those then flow into everything else, because pretty much everything is influenced by the cost of fuel, the cost of energy, transportation, anything that needs to be shipped as an input to manufacturing. There's a whole lot of influence there. So higher fuel prices is now starting to flow through into underlying inflation as well. And because of that, they're still seeing inflation likely to remain high for some time. And importantly, they note that it was already high before any of this. And this is a key aspect to the Reserve Bank's thinking around this that you can see coming through in the commentary here. They make an explicit comment that inflation being high due to higher fuel prices is in addition to the high inflation recorded around the start of 2026, reflecting what they call capacity pressures in the economy. So they have a view that the economy at the moment can only grow at a certain rate before it's eclipsed by demand. So you've got to have demand, spending and so on, growing at a slower pace than the economy is growing in order to try and keep things on an even keel. And the concern was that we were already seeing too much demand leading into the start of this year relative to the economy's ability to deliver, to supply to that demand. And that was causing inflation to be higher than they wanted it to be anyway. So the question is, well, is that pre-existing issue getting any better? Are we going to see that start to improve, which is obviously clouded by all the issues in the Middle East, driving up fuel prices and having that compounding effect on inflation at the moment as well.
The supply side constraints we've discussed in the past, Simon, the supply side constraints were the driver for price rises, which they've classed here as capacity pressures in the economy. People still need to eat, and they still need to do the things that they do to live a life. And the tightening of the belt that's going on is phenomenal right now, but the request is to do more tightening of the belt. And yeah, it's a tough gig to be in. So people are feeling it on the ground, yet you've got inflation remaining.
Yeah, and that's where there's this real conflict, and it creates the real challenge in trying to find a balance here in that, you can raise interest rates to crush demand to try and keep it within the economy's ability to supply. But there are certain things that are discretionary, and there are certain things that are not discretionary when it comes to spending that you need. You need shelter, you need food, you need electricity, you don't really have a choice but to pay whatever the price is for
Yeah,
those
correct.
things. And if the supply side is constrained, it could be because, a drought and you don't have as much product in the supermarkets, and so the price of vegetables goes up. It's the issues with oil supply and driving up prices of petrol, which is then flowing into everything else. Crushing demand doesn't fix the core reason why that's happening. The argument perhaps is more about, well, do we buy ourselves time for the economy to get back into a better balance by doing everything we can to restrain demand whilst the economy tries to build capacity? But the problem there, of course, is that if sentiment is poor and if people aren't spending as much and they're reluctant to spend, particularly on discretionary things, where's the incentive for businesses to invest to increase capacity? And so you end up with this terrible catch-22 that you kind of need confidence in the economy for businesses to invest and grow capacity. But at the same time, you're trying to restrain confidence by increasing interest rates and causing people to spend less. And those two things never sit well together. And that is the difficulty that the Reserve Bank faces here, I think.
One of the biggest forecasted issues that I can see is the fertilizer issue, where without the right fertilizer, you get smaller crops. If you get smaller crops, you get less inventory, less supply of products into the supermarkets. If you get less supply, then you've got a limited supply, again pushing price up. But that's a seasonal impact. That's something that fertilizer today will impact 6 to 12 months from now as inventory hits the shelves for sale. There will be less of it, therefore prices will go up. So there's a perpetual play occurring here that will impact and continue pressure on growth of prices. It's as you say, Simon, challenging position to be in.
You make a really important point there, because even though it's not really explicit here, in fact, some of the commentary here that we'll get to in a second is more about crunch demand than it is about we need to look at what's happening with supply. But I think part of the reason why rates are on hold this month is a recognition that you do need to potentially look through some of this stuff. So if we've got issues that are temporarily constraining supply, like a lack of fertilizer, for example, that's going to flow through into the ability to create some of the essentials crops and so on, you've got to be willing to look through that and just accept that you're going to have some higher inflation for a bit longer, but that'll eventually work its way out, rather than going, inflation's high, we just got to crush demand, put up interest rates. I heard one economist suggesting that the Reserve Bank should lift rates from where they are now to over 5%, which was a bit of a WTF moment for me when I read that. It's like, sure, if you want to completely destroy the economy's ability to recover and get through these issues, go right ahead. But I think the Reserve Bank's at the moment expressing some willingness to look through some of this at least and see how things play out.
Yeah. I mean, if you threw it to 5%, you'd immediately after it had an impact of 6 months, you'd be scrambling so hard to drop them so far to inspire growth back into the economy again, as people cripple themselves under the weight of financial burden. It's phenomenal.
There was some commentary in the press conference after the statement came out where Michelle Bullock, the Reserve Bank governor, was saying that they've kind of learned from their past experiences of waiting too long and then only reacting to things after the fact, and then by then it's too late, to now looking at, okay, we need to move before it's too late, which is part of the reason, I think, behind the thinking of the 3 rate rises we've already had. But that also then leads into we don't wait until things are so bad before we take other action, either holding or reducing interest rates as well. Key messages: growth and demand still needs to slow. So they still want to see that consumer spending coming back. They are acknowledging that the economy is slowing, and we did see that in the recent GDP figures that came out, but still concerned inflation's too high, leading to the decision at the moment that rather than dropping rates, they'll leave the cash rate unchanged for now and wait and see, assess how the economy is responding to previous interest rate increases and the impact of the oil supply disruption. So they feel like they've bought themselves time to sit back now and go, right, well, let's give it a few months. We'll see what happens before we make our next decision on moving the rates in any particular direction. And so key things that they're looking at that we should be paying attention to as investors as well, if we want to anticipate what might be coming. looking at the global economy. So we'll keep an eye on what's happening in the Middle East. Financial markets, trends in domestic demand. So again, are consumers spending too much? Are they reining in their spending? Outlook for inflation, and of course the labour market. But they feel like they've set themselves up to be in a good position to respond one way or another. And that almost implies, hey, we're in a good position to cut rates if we need to, is how I read through that. That said, they don't want people expecting that they're going to cut rates really quickly, because then people go, oh, that's cool, then I'll go out and spend more in anticipation of rate cuts. That's the exact opposite of what they want to achieve. So, and we haven't seen this comment in their statements before. They've made a very interesting comment that they close out on. So they say that in order to deliver price stability and full employment, we'll do what we consider necessary to achieve that outcome. And this last statement, including increasing the cash rate target further if required. So they're making an explicit statement saying, hey, don't just assume that we're done with increasing rates. If we feel that you're going off and spending too much and that there's too much heat in the economy relative to its capacity to supply, we may jack up rates again. And it was very interesting to see that as a final statement there, almost like a warning to people to rein in their expectations so that they don't get too confident, too exuberant to go out and spend.
I actually can see the argument for them continuing to do so. There is so much on the horizon that has a risk of driving up costs that are not demand driven, that is going to potentially force another rate rise. So I'm not of the opinion that we are fully peaked yet. There's risk still existing. I'm also not of the opinion that the next move is down.
So you're sitting on the fence, Brendan. That's not
I am with them. I'm thinking there's so much upside and so much downside that really I think that August will be flat.
Let's look at where the bets are at the moment as we wrap this up. So the big banks are kind of split, although the majority of the big banks, ANZ, CBA and NAB, are all saying that they believe that the current hiking cycle is at an end. Rates are on hold until next year. But then there are 2 to 3 cuts in 2027, depending on which bank you talk to, other than Westpac, which is the outlier at the moment, which is saying, no, we're still going to get 2 more increases this year. So who's right? Well, you can see why it's difficult to provide a forecast here when no one agrees. The money markets themselves, how are they pricing money at the moment? Well, they're seeing only a 25% chance of a rate increase in August. So not no chance. I think your assessment's right, Brendan, that the risk of further rate rises is not gone, but the chances that the money markets are pricing in at the moment are 25% goes up, 75% stays on hold, with an expectation again that towards the second half of 2027, interest rates will actually start to come back. So I think it's possible that we'll see a rate rise in August. However, I'm perhaps more on the side of the money markets at the moment, that I think it's more likely to be hold than go up at this stage. And there are 2 things that I'd be keeping a close eye on over the coming months to see or to refine that view. One is the monthly unemployment stats, because if they continue to get worse, that puts pressure on the Reserve Bank to keep things where they are. Not necessarily to drop rates this year, but at least to keep them on hold. And the next release of that is coming up in about a week on the 25th of June. So you want to look out for that when it comes out and see what that's saying about unemployment. If that's getting worse, more pressure to keep rates on hold. If it's actually an improvement, then that opens the door for the Reserve Bank to go, oh, well, our mandate to maintain full employment is being satisfied.
You said there was
inflation is the other stat. The monthly inflation figures will come out on the 24th of June. Those will be useful to have a look at. But the more important one comes out a month later on the 29th of July, which is the quarterly figures, which are the key ones the Reserve Bank will be focused on before it meets on the 10th and 11th of August for their next meeting. So look out for those bits of data that are coming out. They'll give you a real insight into what the Reserve Bank's likely to do.
Needless to say, we will keep you abreast of any changes that occur on our weekly fireside chats in the property polls. If you are new to the platform, please, I hope you've enjoyed today. It's been a wonderful opportunity to be able to get into the RBA and its latest decision. We do encourage you to participate wholeheartedly into the real estate statistics community. If you haven't updated your profile and filled out, populated your profile, please do so. It makes a difference. for you and everybody. Jump on to Connect and Discuss, write a post, say hello, make a comment on somebody else's post, and let yourself be known. Simon, well done again on today. Thank you very much for all of your support around interest rates and the opinions on that. We wish you a very, very good week. And until we meet again, invest wisely. See you next Thursday, guys.